mind, looking for a dime. James Locke in the house, gonna help you shine.
All right, welcome everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke. Today, gonna jump in there. Some of the Ask James questions of the day. First question is from Tyler. He says, is this going to be like the year 2000 with the bursting of the tech bubble? All right, Tyler, so obviously talking about some of the market volatility we had at the beginning of this month. Well, anything's possible. It is possible. But I would say I don't think it's probable. And the reason is because back then, the price to earnings ratios, the multiples of the S&P 500, they were like over 40. And the multiples of many tech stocks were up in the triple digits back then. And there were 100 or more, and that's because a lot of those companies weren't making a lot of profit. Now, in some cases, they were making zero profit. So Wall Street was, basically totally speculating on the future, much like today, a lot of people speculate on Bitcoin, right? And cryptocurrencies because they're betting on the future. This is going to be worth something in the future. Now, we don't know what it's going to be worth. Crypto doesn't earn anything today, doesn't pay any dividends, have any profits. So we're betting that just something. We're betting on something that will happen in the future. And that's what was happening back in the late 90s when it came to the tech stocks. Today, it's different. All the companies in the Magnificent Seven are now making profits. NVIDIA is profitable, because they're the primary maker for this kind of next generation chip, right? Apple, we know, has been profitable for a long time. Amazon, this is profitable. Facebook has been profitable, right? A lot of people advertise on Facebook, myself included, right? Google, right? Alphabet, they're certainly profitable as well. Microsoft, Tesla. So these companies are all making money. And frankly, are their valuations maybe a little bit higher than the rest of the stock market? Sure they are. But that's what their multiples, they're higher because they've been growing rapidly and the market looks forward. So when the market's looking at, what this company might do, 10, 12, 18 months in the future, if it's at a rapid growth rate, the market kind of extrapolates that growth rate to get a multiple 12 or 18 months out, which means now there's more downside potential because now they have to extrapolate maybe a much lower number. But again, these companies, they're most likely here to stay. They're profitable and the multiples are not out of control, right? So my best guess is no, we won't see another bursting of the bubble like we saw in the year 2000. Now, it's a little bit different when you're talking about companies that are profitable. For investors approaching retirement and focusing on income, this is particularly important. These established, profitable companies often pay dividends, which can provide a steady income stream. Unlike the speculative tech stocks of the dot-com era, many of today's tech giants offer both growth potential and income opportunities. So when investing for income, it's really crucial to look for companies with strong fundamentals, consistent earnings, history of dividend payments. So while the tech sector kind of might not be the first place income-focused investors look, some tech companies have matured to the point where they offer attractive dividend yields alongside potential capital appreciation. So this combination can be valuable for retirees looking to kind of balance income needs with some growth potential because you need that to combat inflation over time. Great question to start us off today. If you want to get your question answered, go ahead and email it in, poolelock@poolelock.com. All right, moving on to our second question. And this is from Andrea. She says the Federal Reserve has hinted that they're going to lower rates maybe even in September. Okay, so shouldn't that help solve kind of these issues we're seeing in the market? All right, Andrea, I know what you're thinking because so far it's all been about the Federal Reserve. This whole year has been about the Federal Reserve speculation, right? Are they going to lower rates? How many times? When are they going to lower rates? And that affects markets' optimism. The sooner they lower rates, the more they lower rates, that's a good thing. Which, Andrea, as you know, it's kind of perverse, right? It's kind of backwards a little bit, because if they have to lower rates, it means the economy's not good. But the fact that they're lowering rates means that ultimately the discount factors go down in the markets. And you've probably heard me say before, quoting Warren Buffett, when he talks about interest rates, if interest rates go up, the value of all financial assets go down. And when interest rates go down, the value of all financial assets typically go up. So the reality is that what the market is looking for, and yes, you're right, the Fed did come out and say, hey, it's more likely that they lower rates in September. At least they hinted at that, right? Maybe 2-3 times this year, maybe even a half point. So that's optimistic. But Andrea, here's the problem. Here's what the Fed also said. They also said they're going to continue to be data dependent. So they have the same robotic language that they've always used, Fed speak. And why did the markets not like that? Well, the markets didn't like it because they're seeing that, companies in real time, right now, not that they want the Federal Reserve to react to a drop in the stock market, because that's not going to happen. But it's no coincidence that right after the last Fed meeting, the next Fed announcement, the next day, the market had a fall off and continued for 3 consecutive days. And that's because real time, we're seeing corporate America say, hey, demand for our goods and services is going down. We're going lower. We're giving lower guidance for next year, that our profits are going to be less. But the Fed is still looking in the rearview mirror, kind of saying, hey, we're going to be data dependent, because remember, they don't have forward data. They only have backwards data, right? So yes, they said that they're more apt to lower rates in September. Yes, they hinted that they might be apt to do even more than a quarter point. But again, because of that data dependent phrase, it spooked the market. So Andrea, hopefully you've listened to other episodes of my Ask James YouTube channel here, because I've talked about kind of data dependency at other times, and it's really a potential problem, because they're looking the wrong way, really. Now, for those approaching retirement, focusing on investing for income, the Federal Reserve situation presents both challenges and opportunities. When interest rates are lower, it can be more difficult to find high-yielding fixed income investments, like bonds, CDs. However, it's really important to remember that a diversified income strategy is crucial. So when we wait for potential rate cuts, investors might consider looking into dividend-paying stocks, particularly those with a history of consistent and growing dividends. So that can provide a steady income stream that potentially increases over time, which is especially valuable in retirement. REITs, I've talked about before, real estate investment trusts, some preferred stocks can also offer attractive yields in low-rate environments. It's worth considering a laddered bond strategy where you invest in bonds with staggered maturity dates. This approach can help manage interest rate risk and provide regular income as rates can potentially decrease. You can reinvest maturing bonds at the new prevailing rates. So remember, while the Fed's actions, they're important, your investment strategy should be based on your personal financial goals, risk tolerance, not just short-term market movements or Fed decisions. It's always wise to consult with an income specialist to ensure your income strategy aligns with your retirement needs and overall financial plan. 2 great questions today, important questions. If you want to have your question on a future show, email it in to Poole Locke at poolelock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the